So there's a lot of very positive things going on with this company. But all right, welcome to Talkin' Investing. I am Tom, and as always, this is not financial advice. Today, I want to do an update video on Romeo Power, stock ticker RMO. I just did a video on these guys about a week or two ago, but they had a significant event, so I wanted to update that video to let everybody know what's going on. Romeo is a small cap high growth stock in the EV sector. We do a lot of small cap high growth stocks. We cover the EV sector quite a bit on this channel, so if you're new to the channel and that is content that you enjoy, please subscribe to the channel and hit the notification bell. And of course, if you like this video, please smash the like button. A little bit about myself. I have a background in accounting. I was a CPA. I've been trading stocks as a retail investor for the last couple of decades. So my hope on this channel is just to share some of my experiences with you guys, and maybe we can make some money along the way. So let's take a look at what's going on with Romeo. So yesterday, Romeo was down about 17%, and it hit its 52-week low yesterday. It has been doing that on a regular basis. If you want to learn more, a deeper dive on what Romeo does, you can check out the video that I just did last week. So it was down 17% yesterday, and today you'll see today's range in the 52-week range. It hit $1.75 today. That is its daily low. That's its 52-week low. That's its all-time low by a mile. So when we get to the chart, you'll see just how drastic this action has been on this stock. In the meantime, there was actually a reason it was down 17% yesterday, and it kind of slid under the radar. There was no press release. I didn't see any news about it. I had to go check the SEC filings to see what was going on. So I just wanted to share what I found so that everybody can be in the loop. This is a Form S3. This was filed with the SEC 2 days ago. Okay, so what is this thing? Under this shelf registration process, we may offer and sell securities from time to time, and in one or more offerings, up to a total of $350 million, as described in this prospectus. What they've done here is a $350 million shelf offering. For those of you not familiar, a shelf offering is a little bit different. It's not an offering where all the stock is sold at one time. It's basically put on the shelf, and they can sell this from time to time at any time of their choosing over the course of, usually they are something like 24 months long. And they don't have to disclose every single time they sell a share. So this gives them access to $350 million. This is potentially equity, and it's most likely equity. They list off, it could be common stock, preferred stock, debt securities, warrants, rights, units. So there's a lot of different ways that they can do this, but in the end, this would definitely represent dilution to your stock if you're a stockholder. So Romeo's market cap is $246 million. So a $350 million shelf offering is actually very significant to a $250 million company. This company, within the last year, was over a $2 billion market cap. So their stock and market cap is down drastically. And we will look at that on the chart in a few minutes. So again, quietly, they did this yesterday, and the market did react. There was a 17% downward push in the stock yesterday. So really, this all comes down to management and your belief in management. If you feel that management is strong in this company and they are going to use this wisely, access to $350 million can be a very good thing. However, if they went out and grabbed $350 million yesterday at a stock price of $1.80, that would actually be a very bad thing. They would have to issue more shares of stock than there are outstanding right now in order to accomplish that. So that is highly doubtful. It will certainly be somewhere in the middle. So we'll talk a little bit. There's a few sections that explain what's going on here and why they did this. So I am hopeful that management will use this wisely, and they don't have to use this either. So if they don't need all $350 million, they can let this expire over time, and companies have done that. But it's there if they need it, and obviously, now is not an ideal time to be issuing stock at your 52-week low / all-time low. But let's take a look at what they say on why they need this, and then we'll take a look at what they say on what they think they're going to do with it. Okay, so this is later in the same document. Recent developments. As of September 30th, 2021, we had cash and cash equivalents of $181 million. We have reoccurring losses which have resulted in an accumulated deficit of $135 million as of September 30th, 2021. As a result of continuing anticipated operating cash outflows, including investments, amount anticipated to be paid to Borg Warner, and costs to support future growth, we believe that substantial doubt exists regarding our ability to continue as a going concern without additional funding or financing. Our management is currently developing plans to alleviate such doubt, but cannot conclude as of the date of this prospectus that it is probable our plans will be successfully implemented or that we will be able to curtail our losses. So that's a bit of a scary paragraph. However, I will tell you that's basically structured the way they need to structure it. For those of you who aren't familiar with that term, that basically just means there is doubt as to whether or not they can stay in business without this money. So that is a very dramatic statement. So now they're not out of cash. They have $181 million. So they're not running out of cash today or tomorrow. So that's why I don't think they're going to be tapping into this instantaneously. Hopefully, they will be using this wisely and just to the extent to which they need it. So they've got $181 million. They think that's not going to take them to the finish line to the point where they are cash flow positive. So they think they're going to need some more cash in order to keep the doors open. They may take $28.6 million and buy Borg Warner out of their joint venture so that it just becomes something that they own completely. We also may use a portion of the net proceeds to acquire or invest in other businesses, products, and technologies that are complementary to our own, although we have no current plans, commitments, or agreements to do so. So they've outlined what they need this for. They're going to use it for general administrative expenses to keep going until they are cash flow positive. Looks like they're going to use it to take Borg Warner out of a joint venture they're sharing with them. They may also use the proceeds to acquire new companies that are consistent or complementary to the business that they are currently conducting. So they wanted to give themselves access to this cash now while they still can, before they get themselves into a situation where they're running out of cash. So it's a $350 million shelf offering, which means they may not have issued any of it yet at this point. They can issue this at any time of their choosing and from time to time. So it doesn't all have to be at the same time, and they don't have to use it all. So really the key question that you have to ask yourself is, do you think management is going to use this responsibly without diluting your stock too much? On the flip side, as a shareholder, you can maybe take a sigh of relief that this gives them access to another $350 million, which hopefully over the next quarter or two, when they report their earnings, they will show us a plan to get to positive cash flow with the cash they have plus this shelf offering. Because obviously we don't want to see a continued series of offerings that just continue to dilute and dilute and dilute the stock. So I want to just take a look at the chart to show you guys just where they're at right now. And this stock has been beaten down pretty much, I would say, worse than any other stock that I have found. I do own shares in this company, and I am holding my shares. Also, we own shares of this in the $10,000 challenge that we have. If you want to learn more about that, you can watch the video that we made. I update that every Saturday. So that is one of our stocks in our 10K to 100K challenge, and I own it personally as well. So I'm not selling any of that. I did actually average in on that 17% dip. This is not financial advice. You guys need to decide what you think of what's happening here with Romeo and what you think this $350 million means before you make any buying decisions. Okay, so if we look at the chart, this is the chart on the 1 day time frame. So each one of these candles represents 1 day. So this is about the last year. This goes back, actually, if we go all the way to the left side, you'll see it's back in November of 2020, and you'll see it was around $10 because this was a SPAC, and SPACs tend to hang out at about $10 until they decide what they're doing. So once they made that decision, there was a massive run up in this, and it got all the way up to $38.90. So this was in December of 2020, and December of 2020 and January and the beginning of February of 2021, a lot of these small cap stocks and SPACs were just going ballistic. So this one went right along with them. So the way I look at this is, this period right here just represents an extremely overbought position. So you can see from its high on December 28th until February 10th, which is just a little over 1 month later, this had a 50% pullback. So that's kind of the piece that I'm going to ignore. That 50% was probably an overbought position. So, okay, it pulled back. The stock cut in half as of February 10th. But what I want to look at is what has happened since then. So after it pulled back 50%, it has now pulled back 90%. This stock had a 50% drop in about a month. And then from that 50% drop, over the course of the next 10 months, this stock had another 90% drop. So effectively, from top to bottom, this stock is now down 95%. That I think is the most dramatic pullback I've ever seen. Most stocks that are down 95% are pretty much companies that are already done and they're winding down, and it's inevitable that they're going out of business. But you can see this is not that company. They are in a growth mode. They ran into a big problem in the middle of 2021. The supply chain hit them so hard they actually had to stop sales altogether. So they had 2 quarters of very close to zero sales. The third quarter of 2021, sales picked up. I think they had $5.8 million of sales, and they're expecting $9 or $10 million of sales in the fourth quarter. And they're expecting sales to go up from there in 2022 to $70 or $80 million for the year. Now, this company also has about $500 million in signed backlog. So there's a lot of very positive things going on with this company, but they did run into a brick wall with this supply chain issue, and they were unable to deliver any products at all for several months. So obviously, that's a big part of what this pullback is, but a 95% pullback, or even if you just want to go from the point in February, it's still a 90% pullback. So for me, like I said, I did dollar cost average into this, but I would say be very careful. This stock's already down 95%, so this is not financial advice. I don't know where the bottom is, but I just wanted to bring everybody up to date because I thought that was a pretty significant event that occurred. So thanks so much for watching, and we will see you in the next video.